But let's move on from one earnings to another. Now, TV Narendran, CEO and MD at Tata Steel, spoke to my colleague Ajay Sharma on the latest update on the European business and the road ahead as well. Let's go cross and listen.
Yes, Europe continues to be a challenge. Things are getting better, slightly better, but we expect another challenging quarter and then things to get better from Q2. A few things. One is our strongest business in Europe is our Dutch business, and Dutch business is traditionally cash positive, EBITDA positive, but they've been challenged because of the rising gas and electricity prices last year, and the need to build up some slab stock because they were shutting down their blast furnace in April. So I think because of these events, the Dutch business had a tough few quarters, but the blast furnace is going to come back on in August, and after that we expect things to go back to normal. So that's the guidance on the Dutch business. Otherwise, in Europe, at a very fundamental level, the gas prices and energy prices, electricity prices have all come down. They're coming back to where it used to be before the war, still higher than what it was before the war, but coming down very significantly to where it was in Q2 and Q3. UK is where we have a slightly more longer term challenge. While the UK business will get better in Q1, it will still be EBITDA negative. But in UK, the other challenge is many of the assets are going to come to end of life in the next year or two, and the business is not generating the cash flows to support any significant investment or transition. That's why we are talking to the government, and depending on how the conversation goes with the government, we'll have to see what is the future of those assets.
So the street is really wanting to know that some visibility on how are things looking from here on demand side, especially in Europe. One sense is that the worst of demand could perhaps be behind us, and demand trends may gradually, however gradual it might be, start improving. One set also believe that Q1 perhaps could be where European side of things may actually bottom out for sure. Plus, of course, what is happening on the macro front on operating costs, etc. If you could share some angle on that.
So there are a few things to be kept in mind. One is Europe is also very closely linked to what happens in China because a number of European countries export a lot to China. So if you look at the sentiment in Germany became positive when China opened up after COVID, right? So things like that because a lot of capital equipment goes from Europe to China. Uh, so if China does well or China does better than it did last year, that will have a positive impact on Europe. Second thing is when energy prices come down, that's positive for Europe because a lot of industries were struggling with high energy costs. And energy prices settling down, gas prices settling down, electricity prices settling down is a positive for Europe. The overhang of the war is still there. If something happens there in terms of some sort of rebuilding or reconstruction starts in Ukraine, that's very positive for Europe. Inflation is still a concern, so that is a deterrent. So, but I would think the worst is behind us as far as Europe is concerned. There's also a lot of investment going to happen there to transition the economy to a greener future. So that will also lead to a positive impact on economic activity. So I think certainly if you look at it from a steel consumption point of view, we are expecting consumption to come back to positive levels from next year for sure.
Let's turn focus on the India business, Mr. Narendran, because that was exceptionally strong. Realization volume both actually picked up pretty smartly. How are things shaping up over there? Do you think this momentum can sustain?
Yeah, India, I think the fundamentals of demand are still very strong because of construction activity. Auto industries got revived. Passenger cars are back to where it was pre-COVID. Commercial vehicles, which is a lead indicator, still very strong. If you look at pre-engineered buildings, industrial buildings, order book is strong. So in multiple areas, we see things are strong. The rural economy is what was a bit more fragile. Consumption at the lower ends of the community was what was fragile, which was reflected, let's say, in motorcycle sales, which is largely sold in rural India. We are seeing that picking up quarter on quarter. If you have a decent monsoon, we expect that to be a positive also. So overall, we are strong on the fundamentals of demand in India, and with the kind of money the government is spending on infrastructure, I think it's very positive. I think the concern is obviously a little bit of what's happening around the world. Industries and companies who are dependent on export markets are a bit more circumspect. that also brings down sentiment a bit. We cannot be immune to what's happening around the world, and I think that's the only concern. From a Tata Steel point of view, we're getting the benefit of the Nilachal volumes. We are now running full out. So next year will be a year when the full Nilachal volume will come to us. We are already running at a 1 million rate. Kalinganagar expansion is going on. We've started the pellet plant, which will help bring down costs for us in Kalinganagar. In the next 12 to 18 months, we will be commissioning most of the facilities in Kalinganagar, and we'll get the 5 million tons additional volume also going forward. So we are very positive about our prospects in India.
A bit on the pricing front, prices of steel price. Last time we interacted, you had indicated that your expectation was that probably 65,000 per ton, it could edge towards, we've crossed 60,000. And do you see some more upside? And also, how is China factor playing a part in this?
So I think if you saw it cross 60, it was around 61, 62, then it's come down again, reflecting more the international sentiment. I think there are two big factors which will drive sentiment, or three factors. One is the domestic demand in India, which is positive. Secondly, China's recovery and resurgence, if any, this year. Uh, so far, the forecast is China will grow at 5.5%, which is good. So if China stays strong, that's good for the sentiment. Third is coal prices. Of course, coal prices are also linked to what's happening in China. But coal prices have come down very significantly in the last few weeks. And then there is an anticipation that steel companies have more margins and hence may have more room to drop prices. But what has happened is coal prices went down, Chinese steel companies dropped prices, but today Chinese steel companies are back to very, very low margin levels. So I don't expect this situation to continue for very long, and you should see a little bit of pushback and on steel prices. And I think this week China is on holiday, and that's why the sentiment is still looking for direction.
Mm-hmm. Mr. Narendran, one key monitorable has been your debt reduction process. This year you couldn't really meet the target which you had, but you have not kept your overall target unchanged. So where do we stand on the debt reduction of $1 billion per year kind of debt reduction which you were spoken about earlier?
Yeah, I think we stick to that. We didn't hit it last year because of more money going into working capital, plus the fact that we acquired Nilachal for 12,000 crores, plus the fact that we also acquired a few smaller assets on the ferroalloy side. So because of all that, the net debt increased during the year, but we are going back to our target of reducing by at least $1 billion. More ever since we announced it, apart from last year and all other years, we've exceeded it. So we expect that next year we will be back on track for that $1 billion.
Okay, that's the word coming in from the MD at Tata Steel. But let's move on and